Okay, so chapter 2, welcome to chapter 2. And much of what we're going to be doing in chapter 2 revolves around the very first learning objective, okay, which is the fact that we actually have different types of assets that we classify, and we have different types of liabilities that we classify. And so we call this a classified balance sheet because we classify assets in certain categories, as you'll see today. And as you'll see on Thursday morning, we classify liabilities in certain categories. And so you're going to be, most of your work is going to be on classified balance sheet. This chapter also does two other things. It introduces you to ratios, which is going to be a huge part of Accounting 102 for you. We do a lot of ratio analysis. So here you're doing bookkeeping in Accounting 101. In Accounting 102, you already know how to do bookkeeping. So we focus on a little higher level stuff, which is looking deeper into the accounts and doing financial analysis. And so this chapter simply introduces you to a few financial ratios, and it's going to be sort of a little sneak peek of what Accounting 102 is going to be like for you. And then we actually are going to understand financial reporting concepts, specifically what is GAAP, Generally Accepted Accounting Principles, and that's just informational types of things to understand what you're learning in this class. Everything that you're learning, from putting together the income statement and the balance sheet to doing bookkeeping very soon, is because there's rules in financial accounting and how things need to be reported. And those rules are called Generally Accepted Accounting Principles, or GAAP. So you're just going to get an introduction to that in Objective 3. But again, what you're going to be focused on in this chapter and in this class is the classified balance sheet. So let's start it. Okay, so remember, a balance sheet is basically a selfie, right? It's a snapshot of a particular day of what assets the company has on that day, what liabilities the company has on that day, and what the stockholders' equity accounts have in them on that day. I think you got the on that day thing, right? I've said it 4 times for a reason, because balance sheets only have a date on it. So it's just for that particular day. Okay, you probably remember seeing that on the title, the company name, balance sheet, and then the date is put there on the heading. But what you might not know is that there are different types of ways in which we can classify assets. 4 different types, so 4 different ways that we classify assets, and that's what we're going to be focused on today. When we come back next time, we're going to be focusing on the other side of the balance sheet, liabilities and stockholders' equity. The good news is only liabilities are classified. Stockholders' equity is not. So let's begin with assets. Assets are actually broken into 4 different classifications. Okay, and there's reasons why they are classified in that way, and you're going to learn that today. So when you look at a balance sheet, the very first types of assets you will see are classified as current assets. They're called current assets. And as you'll see by reading a little bit more in this chapter, current assets are assets that are either going to be turned into cash within the year or used and expensed within that accounting cycle or that year. And so there's a very specific pecking order to current assets that you're going to learn today. Okay, but the word current in accounting refers to short term, and what they consider short term in accounting is up to a year. Up to a year. Again, up to a year from the date on the balance sheet. Remember, balance sheets have specific dates. So if we are going to, if an asset is going to be turned into cash or used and expensed within that year, right? A year from the date on the balance sheet, you'll see it classified as a current asset. Current assets are always listed first in the asset section. You've actually already been introduced to several of them, such as cash. Cash is a current asset. You've been introduced to accounts receivable. Accounts receivable is a current asset. You've been introduced to supplies. Supplies is classified as a current asset. And I think you've been introduced to prepaid insurance. Prepaid insurance is also classified as a current asset. And we're going to get into more detail on those in the next slide or two. Okay, so current assets, assets that are either going to be turned into cash or used up and expensed within one accounting cycle, within 1 year. Okay, again, that word current, within 1 year. All the other assets technically are long-term assets because there's only two ways that accounting looks at things, current and long-term. So if current is short-term, if current is up to a year, then long-term is anything over a year. Okay. So there are actually three ways to classify long-term assets. Okay, assets that are going to be used in the company, owned and used within over a year's period of time. Okay, for a long term. You're going to see current assets on every single balance sheet you look at. What you might not see on every single balance sheet is this classification called a long-term investment. Okay. And as you'll see as we look through a few more slides, a long-term investment are assets that the business owns for the long term. They plan on owning them for longer than a year. But they don't use them in the operation of the business. They don't use these long-term investments to help them sell their products or services, right? So, but they own them for the long term. So there's just a classification that these are long-term investments. So sometimes, I'll give you an example. Let's say I had a pizzeria here in the Poughkeepsie area, and it was doing well. And I'm thinking of expanding, and I wanted to purchase a building in Newburgh. I purchased a building in Newburgh for future use. I'm going to be setting up another pizzeria in Newburgh, but in the future, but I bought a building. Well, I'm not using that building to help sell my pizzas right now, but I own it. That's a long-term investment. That would be under here. Some corporations actually buy shares of stock in their suppliers or other corporations for whatever reason. Obviously, if I'm General Motors and I own stock in a supplier, that stock is something I own for the long term. But it's not helping me sell cars, right? So it's not directly related to selling the product. So it's a long-term investment. It's an asset. I own it. I have to show on the balance sheet that I own it, and then I own it. But I don't use it to help me sell vehicles. So it's a long-term investment. So the reason I explained it in detail, which is great, but you're not really going to see long-term investments on a lot of balance sheets. A lot of companies cannot afford to own assets that they're not using to sell their products. That's not the purpose of assets. That's not the purpose of assets at all. The purpose of assets is to help you sell your stuff. And so having a building and not using it is, you got to think whether that's a smart business decision. Having stock in other companies, it might be nice to say you own stock in a competitor or in a supplier, but if it's not helping you sell your product, how is it really helping you? So you're not going to see a lot of long-term investment classifications on balance sheets when you look at them. Okay. However, you will see the third category on all balance sheets. Okay. The third category property, land, plant, so buildings, factories, things like that, and equipment. It's abbreviated in your book sometimes as PPE. That's why I underlined the PPE. Property, plant, and equipment are long-term assets. When you have a building, you're thinking you're not just going to use it that month and throw it away, right? You're going to use it for 20, 30, 40 years. If I'm a pizzeria and I have a pizza oven to bake my pizzas, I'm gonna use that thing for probably 10 or 15 years or more if I can. It's a long-term asset because I own it and I'm going to use it for much longer than a year. But I'm actually using my pizza oven to cook pizzas, which is what I sell. I sell pizzas that come out of my oven. So it's directly related to selling my product. So it would be part of this classification of asset: property, plant, and equipment. Okay. Property, plant, and equipment are long-term assets that are used in the business to help generate revenue. Good for BOCES, drilling PPE into you guys, into your heads. Good. Excellente. Thank you, Trevor, for letting me know that. That's good. Good job there. So again, property, plant, and equipment, long-term assets that are going to be used for the long term. They have a physical quality. So land has a physical quality. You can touch it, right? Buildings, equipment, things like that. Physical qualities that the business plans on using for many years, okay, to help it sell its products or deliver its services. So it's a very important classification of asset. You're going to see this classification of asset on every balance sheet that you see, along with the current asset section. You'll always see those two listed on a balance sheet, guaranteed. Okay, but they're classified as long-term assets that are used in the business to help sell its products. So, a couple of things that I need to add to this for you. That pizza oven that I bought from my pizzeria, yes, I'm going to hopefully want to use it for 10 years, maybe 15 years. But eventually, I'm going to need another pizza oven. Would you agree? Because as you know, equipment is built to last a long time, but it doesn't last forever. And so I'm actually using the pizza oven to help me generate revenue, because the pizza that's coming out of the oven I'm selling, which is my revenue. So actually the pizza oven is directly related to the sale of my generation of my revenue. And so I actually can expense a portion of the pizza oven's value for this month or for this quarter or for this year, even though I'm going to be using the pizza oven for 10 or 15 years. I can actually expense a portion of it for the period of time that I'm using it right now. I just can't expense it all at once because I'm using it for 10 or 15 years. It's not allowed, okay? You can only expense stuff that you've used up. And I haven't used up a 10-year pizza oven in 10 months, so I can't expense the pizza oven. I have to slowly use it over time. And that's what depreciation is. Depreciation is that process of figuring out how long you're going to use an asset. If it's going to generate revenue, then we have something called a depreciation expense. It's sort of a slow drip over a long period of time, because property, plant, and equipment you're going to be using for 3, 5, 10. Buildings can be used for 30 to 40 years. And so depreciation is this very, very slow way of expensing property, plant, and equipment. The only thing that doesn't depreciate is land, is physical property. The land itself is always useful. I mean, think about, we're sitting on a piece of land that's been here for God knows how many years. It's always going to be useful. Land is something that is always around. And so it never depreciates. It's never really used up. But that's not true for all the other ones, as you'll see. The last classification of asset is getting more and more important over time. An intangible asset doesn't have a physical quality like a piece of equipment. You can touch a piece of equipment, or a building you can touch. But you cannot touch a patent. You cannot really touch a copyright. You can't touch a trademark, because these are basically legal paperwork that allows you to claim that you own an invention. So a patent is specific ownership. The government recognizes that you have invented something, and that patent means you're the exclusive owner of that invention. And so if anyone wants to use that invention and you own it, they're going to have to pay you. Okay. So if I was the inventor of the very small plastic lid that pops off the bottle, it's a very small twist off lid on a water bottle, for example. I'm the inventor of that. I can actually go ahead and sell my water bottle and lid to all of the beverage companies. And if the beverage company agrees to use my bottle and lids, which are my property, I will be getting a royalty for every bottle they use. So imagine I sold my invention of a nice, compact, flexible, lightweight plastic bottle with an easy twist-off lid. And Coca-Cola decides to use it to bottle all of its products. For every single bottle, because it's my invention, I'll be getting some type of fee for that. So patents for inventions can be exceptionally important assets, because that is exactly what I'm selling. So again, a patent is an asset because it recognizes that invention as exclusive property of the company to use and sell. Okay. A copyright is the same way. Look at Microsoft, look at Google, look at other companies like, Apple has a lot of patents. What made Apple famous was its inventions. And so they have a lot of patents on all of their products. Only they're the owner of that patent, and they're the owner of that product. They're the only ones who can say who can do it or not. However, if I wrote a piece of music and a song, then I would want to get a copyright on that to show ownership that it's mine. And if someone tried to use that music without permission, and I lost revenue because of that, I could sue them. And that's what happened to, I forget the guy's name, but I do have the song in my library somewhere here. No. I think you might remember this particular song. Oops.
Everybody get up.
Do you remember this song? Do I have any thumbs up on these? Does this sound familiar at all? All right, so you hear that woo in the background, that and woo, right? Well, that was actually property of some band back in the 1970s. They had a copyright on that particular music. And so when Robin Thicke and company decided to use that, and they came up with a very big song, they used someone else's property to make money. That's illegal. So that's why the group that created this song in the 70s, they had the copyright. And the copyright was able to prove to the court they own that, hey, 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 woo, song. They own the music. And thus, they were entitled to the revenue and the profits of that song. And they won in court because of this intangible asset called the copyright. That's how important they are. Disney owns all those characters and all those songs. I mean, all those characters and all those movies.
I don't think with some fairy tale story characters that most of them they don't own them. They just own the designs and what.
No, Disney actually owns all the characters.
I know that, but if like fairy tales like Peter Pan and like the and Rapunzel, there's like they own the designs, but I don't think like people own like the names and whatnot.
If it was created by like I'm just talking specifically about Disney, and so Peter Pan actually is a Disney product, and so they own that actually.
Right.
They own all the characters, they own the story. So what I mean by this is if McDonald's wants to put a Disney character in their Happy Meal, and a toy company wants to create that Disney character to put in a McDonald's Happy Meal, guess who has to get paid permission for that to happen, right?
Disney.
Disney has to get paid for permission for all of that to happen, for that toy company to create the character, and for McDonald's to actually have it in their Happy Meal. So that's how important intangible assets are. They're extraordinarily important because they are, for a lot of companies, I mean, Google has that search engine, which is a piece of software. Microsoft has all types of software. You play a lot of video games, all that software, all that's owned by those particular companies. But if you have a Sony PlayStation or an Xbox, that's a patent. That's an invention from a particular company, either from Microsoft, or if you have Xbox, or Sony Corporation if you have PlayStation, right? So I really think that it's important to sort of understand how important intangible assets have become over time. And they are directly related to selling certain things. Everyone here has a credit score. Well, you know, the largest credit scoring company called Fair Isaac Company, which is where the word FICO comes from. The FICO score basically is an algorithm. It's basically a huge mathematical formula that's owned by that company. And when they dump your credit information on the formula instantly spits out a score which tells a lender whether you're good for the loan or not. How risky are you to lend to? They own that formula. That's their entire business. They make all of their money from a mathematical formula. And they own it. And only they can call themselves FICO score, a FICO score. So I think it's important to sort of understand how important intangible assets have become. That's my point. That's my point. And you'll read a bit more about it as we go. Okay. So let's take a look. This is going to be one of the more important balance sheets you're going to be looking at a lot in your book. It's on page 47. And it's a very, very good guide to understanding all four classifications of assets are listed here. Again, this is just a way to classify assets. These are not specific asset accounts. They're just ways in which we classify them, okay? Current assets was the first classification. You'll always see current assets listed first in the asset section of the balance sheet. This particular company, Franklin Corporation, has some long-term investments, but you will rarely see long-term investments on many, many company balance sheets. But a long-term investment, again, is something that the company owns, but they're not using. That's the classification. They own it for the long term, longer than a year, but they're not using it to generate any sales of their products or services. Whereas property, plant, and equipment is directly related to selling their products and services. Like my pizza oven, it's directly related to selling my pizza. So in my refrigeration system, because if I didn't properly store my ingredients, I wouldn't be able to make really delicious pizza in my pizza oven to sell. So if there's any property, plant, and equipment that is directly influenced by selling my product, it would be under property, plant, and equipment. Long term means the company plans on using that over a year. Okay. And then the last category, intangible assets, we just talked about for a while. They don't have a physical quality. They're basically pieces of paper that prove that you own an invention, or you own a piece of music, or you own a piece of software, or what have you. But it's directly related to what you sell. And it's very, very important. So it has its own classification, intangible assets. Notice that in the far right column here, these are the totals. So this $22,100 is the total for current assets listed on the side. This $7,200 is the total for long-term investments. This $29,000 is the total for property, plant, and equipment. And this $3,100 is the total for the intangibles. So there's 4 classifications of assets, and there's 4 totals for each classification. Then, of course, all those 4 numbers are added up for total assets. Now, the most complicated part of the assets section of the balance sheet is current assets. So we need to spend a little bit of time on this, and you'll get used to it as we go. But current assets are listed first and foremost in liquidity order. Liquidity order means that it's cash, or it's going to be turned into cash within, well, very soon. Okay, within 1 year, certainly within a cycle, but mostly a lot sooner than that. Okay. The next way of classifying current assets is after we use them, we'll be using them quickly, we can expense them that same month, that same quarter, that same year. And so current assets are sort of broken into very, very first part is liquidity order. And we're going to go through each account so you know what they are. And then after that, they're put in expense mode. Okay, they're assets that they're going to use for the short period of time, and once they use them, you can expense them. And you've already seen some of that with supplies and prepaid insurance in Chapter 1. Okay, the relationship between that and the income statement. All right, so cash is cash. When a company says they have cash of this amount, this is their main bank accounts. This is the total amount of money in their main bank accounts. They may have a little bit of cash on them, but it's basically the main amount of money they have in their bank accounts. So cash is cash. You can go to the bank anytime and get cash. Okay. 24/7 accessibility to your accounts. So this is cash is liquid. This often confuses a lot of people, debt investments. And so I need to make sure you understand a little bit of that. Let me go back, if you don't mind. I need to go back and tell you a little bit of a story about your paycheck, okay, to explain this. When you get your paycheck, you can only do 2 things, believe it or not. You can only do 2 things with your paycheck. You could either spend a big portion of it, or which is called consumption. The word is consumption. So consuming it means you're spending it. The other thing you can do with your paycheck is invest it. Okay, investing, saving it for later on, saving it for the future. We call that investment. So as an investor, you really only have 2 choices, believe it or not. You can either be a lender, which means you can lend your money and get interest on that investment. Or you can be an owner, which means you can own stock or own real estate or own something else. Right? Those are the only 2 choices that investors, you're either going to be a lender or you're going to be an owner. If you're a lender, you've lent money, right? You've let The United States government borrow money in the form of a loan. You let a corporation borrow money in the form of a loan. You let your bank borrow money, because when you put money in the bank, you're giving your bank a loan. They're paying you interest on it, the loan. Interest is the price of a loan. And if you're getting paid interest, it's because you made a loan. Okay. Just like when you pay interest because you have a loan. So a debt investment, probably the most common one, is a money market fund. When you put your money in a money market fund, the money market is short-term lending. Usually it's to the federal government, to bank-to-bank loans, to very, very, very large corporations. Only the largest are involved in the money market. The money market is a debt investment. Okay. A money market is a debt investment. And so if you have a money market account at a bank, or if you have a money market mutual fund, that's a debt investment. Now, the wonderful thing about money market funds and the money market in general is if you need cash, if you need your cash back, you can get it at the end of the day. You got to wait till the end of the trading day, which is 4 o'clock, after 4 o'clock, and you'll be able to cash that out if you need it. Okay. So a debt investment is almost as good as cash, but you have to wait for the day, the end of the day, to turn it into cash. That's why it's listed second. Cash is already cash. Debt investments will be turned into cash by the end of every business day. Okay. Accounts receivable, as you know, happen when you sell something to somebody and you wait to receive payment on what you sold them. And so most of the time, as you're aware, you do not want to wait longer than 30 days. You're expecting payment within 30 days. And so accounts receivable will be turned into cash within 30 days because they're going to be sending you cash because that's what you're waiting to receive. Accounts receivable is I'm waiting to receive my cash because I've already done the work and you need to pay me. So accounts receivable will be turned into cash in 30 days. So cash is already cash. Debt investments can be turned into cash at the end of the day. Accounts receivable are expected to be cash within 30 days. You see that there's an order now. Well, some businesses, again, accounts receivable usually are business to business type of thing. You and I cannot walk in and grab something and say, I'll pay you later. We'll be arrested. So, you know, but businesses, once they get to know other businesses, will often say, yeah, okay, I'll sell you this and here's an invoice, pay me later. I'll wait to receive it. Some businesses need longer than 30 days to pay their receivable. So they might need 90 days. Well, then what the business does is, look, okay, we will lend you the money for 90 days and we're going to charge you interest on that money, and it's going to be due in 90 days instead of 30 days. That's a note receivable. Matter of fact, that's how most notes receivable are created. They're accounts receivable that the business cannot be, they're not going to be able to pay within the 30-day period. They need a longer period of time. And the company says, okay, I'll give you 60 days, 90 days, 120 days, whatever, but I'm going to charge you interest, so now it's a loan. And there's going to be a due date. And that's what, remember, the word note means loan. So this simply becomes a short-term loan. Most notes receivable are short-term loans. Like I said, 60 days, 90 days, 120 days, something like this. So it will be turned into cash within 60 or 90 or 120 days. Okay. So again, cash is already cash. This is the liquidity order. Debt investments, like your money market mutual fund or your money market account, can be turned into cash at the end of the day. Accounts receivable is going to be cash within 30 days. And notes receivable is going to be cash within 60, 90, 120 days, something like this. So do you see that there's a liquidity order to it? That's what's really important. Inventory is the end of liquidity order. Inventory, as you know, when you walk into a store to buy something, you see a whole bunch of products on the shelf. The store had to buy that first and put it on the shelf for you. That's their inventory. The purpose of Walmart having all those things on the shelf is to sell it to you. They want to turn that into cash. Okay. And so the problem is some of those things will be selling very quickly that they have in the store. Some of those things might take months to sell that they have in the store. And so inventory will eventually be turned into cash. We just don't know when. Sometime within the year, we're going to get rid of it. If we can't sell our inventory within a period of time, it goes on clearance, right? Because they just want the cash at that point. Right? We tried this product, it didn't sell. Let's put it in clearance. We just need the cash. That's really what they're looking for. So inventory will eventually be turned into cash sometime during the year. Okay, that's why it's listed last year. But inventory, once it is sold, now becomes expensed. It becomes our first expense. Cost of goods sold is an expense account that tells us how much inventory we sold to customers. So the inventory here, I didn't mean to make a cross. The inventory here is kind of two things. It will be turned into cash once it's sold, but after it's turned into cash, we can't expense it. It's an asset that once we sell it, we can expense it. Okay. And remember, that's the whole point of having inventory for Walmart. All those goods on the shelf are for sale. They want to get rid of them. They want to sell them to customers. After they sell them, they actually can expense it. We already know about that for supplies. Supplies are current assets because they're going to be used to deliver things, our products or services to the customer right now. This is something that's going to be happening within a short time. That's why it's current asset, right? Within the year. And so we buy supplies to help us deliver products or services to customers. And once we deliver those products or services to customers, when we use those supplies, they become a supplies expense on our income statement. Prepaid insurance, as we've gone over before, we own that, right? We bought upfront 6 months or 1 year insurance policy on whatever. Could be a vehicle, could be business liability insurance, what have you. We've purchased a full 6 or 12 months. It's our asset up front. Once we actually use up the prepaid insurance, which we are going to be doing every month we're going to have 1 month less insurance on the policy. So after the month is done, we can expense the month, and that's what insurance expense is on the income statement. It comes from the used prepaid insurance. So this is really going to be critical, and much of your homework is going to be focused on understanding how to put together the asset section of the balance sheet, but the current asset section is one of those that has a very specific order to it. So I would suggest that you really print out, or to make sure you have page 47 handy, which is the Franklin Company balance sheet. So once the question comes up, put together this part of the current assets on the balance sheet. You know the order. This is going to be very, very helpful in putting the order together for your homework. Mm-hmm. The only other classification of asset that has a type of order to it is property, plant, and equipment. Okay, and of course, you're going to see current assets and property, plant, and equipment on every single balance sheet, I can guarantee you. Guarantee you, without question. You're going to see those two classifications on every single balance sheet. You will probably not see long-term investments on many balance sheets. Intangible assets, depending on the type of company it is and what it does, you'll see them or maybe not. But property, plant, and equipment, again, the word property in this case is related to land. So land is always listed first under property, plant, and equipment, always. And then, of course, this only has one other PPE account, equipment. but it would be listed in the order of how long they're going to use it. So buildings would usually be listed second, because buildings tend to be used for 30, 40 years, okay, or more. Equipment is usually listed after that, because equipment could mean anything from a computer to a delivery truck to my pizza oven. So how long do computers last? Maybe 3 years. How long does the delivery truck last? I don't know, maybe 5 years. How long does my pizza oven last? Maybe 10, 15 years. So it basically is going to be, but it's less than what a building lasts. So it's going to be listed next. And you'll sort of see that as you look at balance sheets. The PPE accounts usually are listed in a way that how long they're going to be using them. From the longest, which is land, because that's always available, to the shortest. Okay. Equipment is listed here. The $24,000 is what we actually paid for the equipment when we bought it for our company. But like I said, once we actually use that equipment, even though we might be using it for 10 years, we're using a portion of its value today to generate revenue. We'll be doing that every day for 10 years. Okay. So the portion that we actually use to generate revenue now, in this month, in this quarter, in this year, we actually expense as depreciation expense. We also keep track of how much depreciation we have expensed from our property, plant, and equipment accounts, in this case, just equipment. And that's what the accumulated depreciation account is. The word accumulated would tell you that over time, it's built up. So this $5,000 is basically how much of this equipment we have already expensed through the years. Okay. And so we bought a piece of equipment for $24,000. We've already been using it for some time, apparently, because we have already depreciated $5,000 of that equipment. In other words, we've used up $5,000 of value from that equipment to sell our goods or services. So what's left of the equipment is called a book value. And you might have already heard that term at some point in time in your life. But the book value is simply the original price that we paid for the asset minus how much of it we've already expensed, accumulated depreciation, over time, leaving basically the book value. Okay. And so you're going to be hearing a lot about that. Matter of fact, when we get to chapter 9, way in Accounting 102, you'll actually be calculating that pretty easily. It makes sense. You'll understand depreciation because we'll show you how to do it. And you'll understand that book value thing much, much better by then. But just so you can understand what all these numbers mean and what the accounts mean, I'm just kind of going over that. And of course, this is simply the asset section of the balance sheet, so we have to total it. Okay. Your book has, and we're going to go through liabilities and equity next time. So again, I've already explained current assets are going to be converted to cash or used up within the year. So that's where the word current comes in. If you see the word current, you're thinking short term. If you're thinking short term, it's within a year. Okay, within a year. And we've already been introduced to many different types of current assets, like cash, like short-term investments, like receivables and inventories, etc. This is the just a small portion of the Southwest Airlines balance sheet showing its current assets listed here. Now here they have short-term investments listed instead of debt investments, but they mean basically the same thing. Okay. Short-term investments, again, you can cash out of the market at the end of every day. No problem. And so that's just a little bit of a different terminology for similar account. Long-term investments, again, the most important thing to know is the company owns them, but they're not currently using them in their operating activities to generate the sales of their goods or services. Okay. And here is a partial balance sheet for Google showing that they have basically stock. Equity is the same as stock. Okay. And then actually, those are good things to know, right? Because there's interchangeable terms in accounting. So net income, profit, and earnings mean the same thing. Well, equity, stockholders' equity, key, equity and stock mean the same thing. Ownership means the same thing. Property, plant, and equipment is explained in your book. Again, long, useful lives in the business. Like I said, from a computer for just a few years to a building for 30, 40 years. They have to be currently used in the operating of selling whatever they're selling. They are subject to depreciate, as we looked at. Okay. The only property, plant, and equipment account that does not depreciate is land. All the other accounts, buildings, equipment, vehicles, furniture, and fixtures, all the other accounts depreciate. Good. Here is a partial balance sheet from Tesla showing its property, plant, and equipment listed here. Okay. Now here, the order is not specific to useful life. But normally speaking, you'll see that in this textbook. And intangible assets, again, they don't have a physical quality to them. We've talked a bit about patents and copyrights. We're going to be learning all of these, again, in Chapter 9 in more detail. You're just being introduced to certain accounts now. And here's the Walt Disney Company partial balance sheet showing the characters, their licenses and trademarks, et cetera, that have value. Okay, so your do it exercise in the book, it's important for you to review this before you start doing your homework. It's on page 49. So if you go to page 49 in your textbook, you'll see the do it exercise 1A, which focuses on assets, the asset section of the classified balance sheet. Here we have Baxter Hoffman is the name of the company. They have the following information for December 31st, 2017. And here are the accounts, right? Prepaid equipment, prepaid insurance, cash, equipment, accounts receivable, inventory, and accumulated depreciation on your equipment. And they're asking you to prepare the asset section. So the first question you would have is, what goes first in the asset section of a balance sheet? Current assets. So pick out your current assets first. So we have prepaid insurance as a current asset, cash as a current asset. Equipment is not a current asset. It would be classified as property, plant, and equipment. Accounts receivable is a current asset. Inventory is a current asset. Accumulated depreciation for equipment is a property, plant, and equipment account because it goes with equipment. So now we have we've identified 4 accounts as current assets. What's the order of those accounts on the classified balance sheet? Well, cash would be listed first because we listed in liquidity order first. Accounts receivable will be turned into cash within 30 days. Inventory would be turned into cash within the year's time. But once we sell inventory, we can expense it, which is exactly the same for prepaid insurance. Once we use it, we can expense it. So that's probably going to be the order of our current assets. And as you see, current assets are listed here in the order we talked about: cash, accounts receivable, inventory, and prepaid insurance, okay? Notice too that once we do the current assets, we total them in the far right column of the sheet, showing the total current assets. That's a very important aspect of financial accounting. We total the current asset section and put it on the side, okay? And then as we go back here, we know that property, plant, and equipment and accumulated depreciation for equipment are PPE accounts, property, plant, and equipment accounts. Equipment would go first. Accumulated depreciation for equipment would show how much of that equipment we have already expensed through depreciation. The difference in those two numbers is the book value. So as you see here, property, plant, and equipment is listed first. We take away our accumulated depreciation, how much of that equipment we have expensed through depreciation, leaving a book value of $8,000 for the equipment. Total assets are always the way we're going to finish, $15,600. So your homework is going to look like this. Your homework is going to look like this. So you're going to want to make sure that you have page 47 handy, which is the example in your book on Franklin Corporation that we went over. It has all the accounts that are listed in the order that they would normally be listed on. You also have this do-it exercise on page 49 that has the accounts listed in any old order, and you see how we have to put it in the order, right? Current assets has a specific order, and then property, plant, and equipment accounts. Those two accounts, types of classifications of assets, you're going to see on every single balance sheet. Notice what's not here. Long-term investment accounts are not here, and intangible assets are not here because a lot of companies don't have them. But if they did, they would be classified in the order you were taught. All right, so I'm going to go ahead and stop that. Bring us back to the big screen here. Ask you all to kind of put your cameras on temporarily and see if there's any questions on what we just went over. Do I see a foot? I think I see oh, it's a hand. Okay. I hear someone talking, but I can't hear. Michael, is that you?
No.
All right. Well, if there are no questions, that's what I'm going to be releasing the